Unfortunately, there's a lot of bad news for people in LA, and I was getting a lot of updates from my family because my in-laws live in Tarzana, which is just on the other side of the Santa Monica Mountains from the fires in the Pacific Palisades. So if the winds had been blowing the other direction that day, their neighborhood probably would have burned down. Um, and there's an interesting tie-in to accounting or actuarial science, which has an accounting related, element to it, because there's all this talk about how a lot of these homes in the Pacific Palisades were uninsured because State Farm, one of the big insurers for like fire insurance in that area, had dropped 1,300 policies or maybe more than that.
And recently, right? In the last few
Yes.
years, it was
Yeah. And they dropped them recently. Like my in-laws' neighbors got their policy dropped by State Farm. They still have theirs for some reason. But I bet you every insurer is now going to drop the policies in those areas. And the question is, why is that happening? Well, it turns out that California has these crazy rules about how insurers can calculate the cost of insurance. Step back for a second. How does insurance work? It's pretty
they
simple.
they figure out the risk, and then the math that I'm gonna have to pay out is this much, and I need to collect this much to offset that, and that's how they
Yeah.
calculate it. It's math, right? At the end of the day.
Yeah, actuarial math. They project out what is the potential loss from like a disaster, and we have to make sure as an insurance company that policies are priced so that we can pay the claims when they happen. And then they do this reinsurance thing where they like sell the risk off to bigger insurance companies, global insurance companies to make sure they're insured. And it's this, giant industry, right? Well, in California, um, private insurance companies, like for this, are not allowed to use catastrophe modeling to set premiums. So, so they can't use future-looking models to set premium risks. They can only use historical numbers. So this creates a problem when you have a climate that is changing and causing more severe disasters because they're not allowed to say, well, due to climate change, we're now going to have more Santa Ana winds. We're going to have more variable weather, which in the last 2 years, we've had a lot of wet winters in LA, which led to a lot of vegetation growth. And then, a lot of dry weather now and Santa Ana winds, just that makes for a catastrophe waiting to happen. Now, somebody could model that out if they're allowed to do it, but it's nuts. Insurance companies in California are not allowed to do that. They can only price based on the past.
So if you got your insurance for your house, let's say in the mid 80s, because you've been in your house for 30 years now or whatever that rate was, because maybe the risk was lower then, so the rate was lower. They're not allowed to raise the rate because now it's more risky where you live.
Yeah, they can only raise the rate based on what has happened in past years, not what will happen in the future.
So now they can raise the rates because something just happened.
Yes.
But that's not
not based on anything in the future. Talk about crazy. And so it creates this problem in the insurance market because you can't price correctly. And so homeowners just get their policies dropped. And then the only way that they can get insurance is to buy it from the California insurer of last resort, which is like a government-backed insurance company. And that is totally undercapitalized and is not going to be able to pay out all the claims because they have exposure that's like estimated now at $458 billion, but they only have $7 million in cash.
That's not going to work.
Right. They have a tiny fraction of what they have to pay out. So who's going to pay these claims? Well, it's going to be taxpayers eventually, right? That's how it's going to work.
There'd be a federal bailout of some type.
Yeah. So it's just a lesson in like what happens when politicians get involved in trying to make economic decisions, like top-down economic decisions, and they screw up markets, and you get this kind of situation.